rates as one of the significant stuff. So we really need to understand the different kinds of definitions that are associated with the interest rates, different kinds of measurements that are associated, and how I typically analyze the interest rates. So all these things and the different dimensions with respect to the interest rates, how I use them as a part of the valuations process, all these things is what we are going to look at as a part of this session. So let's get started off. Now, the first thing we need to understand in this context is the different types of interest rates which are generally used for the valuation purposes. The different types of interest rates. Broadly, I see to start with, we work with three different kinds of interest rates. One is the Treasury rate. Then we talk about Libor, and then we talk about Repo rate, though there are so many others. Initially, I would like to touch base upon these three kind of rates. But before I even get started into that aspect, when I simply ask you what is an interest rate, we simply talk about two major roles, a borrower and a lender. That particular rate which a borrower will pay additional on the borrowed amount from the lender, that particular rate which the borrower promises to pay to the lender, that is what we call as the interest rate. Let's say the lender has lent $1,000 to the borrower. At the end of 1 year, the borrower pays 105. Means the additional 5 that the borrower has paid to the lender is what we are calling as the interest. And this 5 is paid over 100 that has been borrowed. So I convert it into percentage, it works out as the interest rate for that particular period. Now what we typically see is the interest rate number is different in different contexts. Probably when I am talking about depositing my money in a bank, the interest rate would be different. If I am taking a housing loan, the interest rate could be different. If I am taking a personal loan, the interest rate could be different, because all these interest, the definition is still the same. There is a borrowing and a lending in the process, and that particular additional amount which the borrower is agreeing to pay to the lender for taking the capital, for taking the loan from the lender. But the interest rates are different in each of these cases because of difference in the credit risk that is involved. When I say the credit risk here, we are talking about the possibility that the borrower may default, may not pay the interest and principal on time. So if the possibility of default is higher, then the credit risk is higher. Possibility of default is going to be higher, then we say credit risk is higher. Then in that case the interest rate will be much higher, because the lender is taking a higher risk by lending the money, because there is a good chance that he will not get his money back. So what he typically is doing is he is trying to increase his expected return. The higher the risk, the higher should be the expected return. So he is trying to increase the expected return, and which is why he is entering into a higher interest rate. So the higher the credit risk, the higher would be the interest rate promised by the borrower to the lender. And that is how the interest rate numbers differ from transaction to transaction. A pure analysis of credit risk, the possibilities of defaults will give rise to what kind of interest rate should be applicable. Now, the first kind of the interest rates which we need to be comfortable with is the treasury rate. Generally, it is the borrowing done by the government. So, government borrows on a short term for 3 months, 6 months, 1 year by issuing what is called as treasury bills, or sometimes it could borrow in the long term for longer periods by issuing what are called as treasury bonds. Now, this is the way the government borrows from the general public and investors. So investors lend money to the government. Investors lend money to the government either in a short term or in the long term and in the domestic currency itself. So this does not take foreign currency itself. And we are all aware of this. The government, it's very rare that it will default. Right? Any borrowing done by the government generally is considered as highly secure. Very rare that the government is going to default in any case, and that too in its own currency. So that's the reason we use an alternative word for the government rates called as risk-free rate. We see at a lot of places we would be using this concept of risk-free rate, sometimes denoted as RF. For all the valuation purposes, we will be using this concept of risk-free rate, which is nothing but the rate that is associated with the government's borrowings. With the investment, from an investor perspective, they are called as investment in government securities like treasury bills or treasury bonds. And from a government perspective, it has raised the loan in the short term or the long term by issuing these kind of securities. So, especially for the valuation purposes at a later point, we'll see that there is a possibility that we use risk-free rate for evaluating many securities. But what we are seeing in the practical world is various traders, they believe using Libor more compared to the risk-free rate for the valuation. What they typically say is this risk-free rate typically, which is the treasury rates, they tend to be very much low in a practical scenario because of various tax and regulatory issues. So they are not a real reflection of the market. So they don't really reflect the market rate. They are artificially low because of various tax and regulatory reason, and that is where they try to use Libor as something that is for evaluating the derivative securities. Typically stands for London Interbank Offered Rate. Now the sentence itself is clear, the acronym is clear. London Interbank Offered Rate. So this is the rate at which one bank is prepared to deposit its money, generally large sum of money, with other banks. So this is the rate. So what is the kind of interest rate which a bank is expecting if it really wants to deposit its money with the other banks? So it's a kind of a borrowing rate. So from the other bank's perspective, it is trying to borrow from this bank. So this is also a kind of a borrowing rate, but not by the government here. The borrowing is generally done by the banks here. And the bank which is depositing is actually the lender bank. So the lender bank will actually quote what is the kind of interest rates it is expecting if it wants to deposit for 6 months, 3 months, 12 months, any different kinds of periods up to 1 year, even 1 month, different periods up to 1 year kind of stuff. So these are called as Libor quotes. So typically it is seen that compared to a treasury, the banks, the default rate is slightly higher because it's not government, it's a bank which is a commercial setup. The default rates are slightly higher. Generally we see that they are having a credit rating of AA, whereas when we look at the treasury, you can look at it almost as a AAA kind of a credit rating, which means the default levels are almost zero. But yeah, even in this case, the credit risk is much lesser, slightly more than the treasury rate. So what we see is the Libor rates are slightly higher than the treasury rates, but from a true realistic perspective, they are much more realistic kind of rates compared to the treasury rate. So that's the reason for valuation of various derivative securities. We see that Libor is being used compared to a treasury rate, and all these Libor is typically traded in the euro currency market, and this is one more reason why people tend to use it. It is traded in the euro currency market and no government has any kind of a hold on it. It's not regulated by any government, whereas here it's a government's kind of a borrowing mechanism. So even from that dimension, we see that Libor has a lot of importance compared to a treasury rate in terms of valuation. And what we see is if more borrowing of the US, let's say borrowing of a currency is happening, so everything, the rates are market determined. If the borrowings of a particular currency are more and the lendings are lesser comparatively, borrowings of a particular currency, borrowing of a US dollar is more than the lending of the US dollars, then what we see is the Libor will increase. Right, borrowing of a currency is more compared to the lending, then we see that the Libor for that particular currency is going to increase, otherwise it's going to decrease. So that is one more important interest rate that we typically look at, the Libor. And in some cases, the other dimension of the interest rate is also called as a repo rate. In detail, it is called as a repurchase agreement rate. See, generally what we see is a party which is owning some kind of investment securities. It is lending, it is selling these securities to a third party, getting cash, and after some time it is getting the securities back and paying cash. Paying cash and getting a securities back. Now what we see in this transaction is the cash which it has received here is lesser than the cash which it has to pay to get back the same securities, and that additional payment that it is making for its own securities is what is the interest rate that is involved in this process, and that interest rate is called as the repo rate. So it's as good as this particular party A has provided a loan to this company for a short period by taking the securities of this company as a collateral, and once this party pays back the cash with a higher interest rate, the securities are returned back. Here, for both the parties, there is it can be structured in such a way that it's a win-win for both the parties. Basically, if we are seeing this party has got the cash, right? In case it does not pay back the cash on time, this party can keep the securities and it can sell off the security. In case this party is not returning the securities, this party can keep the cash with it. So this kind of a transaction where securities are sold off to some other party in return for cash, and with an intention that these securities will be bought back at a later point at slightly higher rate of interest. And in most of the cases we see this kind of this kind of transaction, they carry a very little credit risk because even the time period of borrowing is very small. On the worst case, we even see overnight repos. So borrowing done only for one single day. But in some cases, it can go for a slightly longer period, and that's the reason we call as term repos, which are like three borrowings done for a 3 to 1 month, 15 days, 3 months kind of a purpose. So traditionally, we see that at a higher level, either a treasury rate could be there, Libor rate could be there, Repo rate could be there. These are the different kinds of definitions that could be associated with the interest rates. But what we really need to know is when someone has quoted, let's say you go to a bank and you do a deposit with the bank, right? You go to a bank and you do a deposit with the bank, and the bank said 10% per annum is the interest rate. Now, it will always say 10% per annum. But how much you get after 1 year depends on what is the compounding frequency. The quotation always is 10% per annum, which looks quite straightforward for us. So if at all I have to know what is the exact amount I am going to receive for a 1 year investment, then I have to understand the compounding frequency, which means the actual mechanism in which the interest rate is measured. Is it measured on a semi-annual basis? Is it measured on a quarterly basis? Or what is the precise method in which it is measured? So the compounding frequency will change, will determine how much are we really going to get. So it's as good as saying if it is 10% per annum compounded annually, then probably if you have deposited 100 now, at the end of 1 year you are going to get 110. But if it is compounded semi-annually, then it is like if you have deposited 100 now, it is going to give you 100 into 1 plus 10% per annum, but the compounding is happening semi-annual. So I'll take the semi-annual interest rate here, 5 by 100, and there are two semi-annuals in 1 year. So it is actually going to give you 110.25. Similarly, if the compounding is happening quarterly basis, the same 100 which you have deposited, it will become 100 times 1 plus 2.5% per quarter, and there are 4 quarters in a year, so it is going to become 110.38. Similarly, when you are going with a weekly kind of compounding, the same 100 of yours, 100 into 1 plus whatever the 10%, 10 divided by 52 is the interest rate per week, divided by 100, and there are 52 such weeks. So this is going to give you 110.51. Like that, what you see is as the compounding frequency is changing, the amount which you are going to get at the end of 1 year is changing. In general, if your compounding frequency is m times a year, what we simply say is if your amount is, if you have deposited 100 now, it becomes 1 plus r by m. If r is already in percentage, r percentage by m to the power of mn at the end of n